How banks control your money's value, the inside story. In this video, you will discover how banks control the value of your money. If someone asked you today why you put your money in the bank instead of under your mattress at home, your answer would be, we put our money in the bank because it is the safest option, and they give us a little more money because we put it in a fixed savings account. But when we put our money in the bank, something else happens. We lose control over our money. Before we find out how banks control and manipulate our money, watch this video to see how banks control and manipulate our money. If you appreciate the video you watch and want to help us continue creating interesting content, we kindly ask you to consider the idea of subscribing to our channel and leaving us a donation to support us. Thanks to your support, we will be able to continue improving and offering you new insights. You can do it here below, through the appropriate buttons, subscribe, and thanks. Now let's dive into the famous Spanish TV show, La Casa de Papel. In this show, a group of daring robbers break into the Royal Mint of Spain. Their goal is to steal more than 2 billion euros. According to their leader, the professor, the point is not to steal from anyone, not to take money from someone's bank account, but to create new money. This is exactly what central banks around the world have been doing legally for decades. Although they don't literally operate the printing press or hold it at gunpoint. In recent years, central banks around the world have created money on a scale that would make even the Spanish robbers blush. For example, in the aftermath of the 2008 global financial crisis, the Bank of England printed almost £1 trillion in new money, injecting it into the economy. Meanwhile, the US Federal Reserve printed more than $7 trillion since the 2008 financial crisis. You might wonder why central banks can't print enough money to save you from the rising cost of living, but unfortunately, it's not that simple. Central banks can legally print money, but only when it is truly necessary. In the 1980s, Japan experienced remarkable growth and became a global capitalist powerhouse. During this period, Japan excelled in producing everything from cutting-edge electronics like the Walkman to automobiles. However, in the early 1990s, dramatic changes occurred, triggered by the bursting of the economic bubble, and a decline in consumption by individuals and businesses led to an economic slowdown. The decline in demand led to stagnation and a fall in prices, which in turn led to a slowdown in inflation. Faced with this challenge, the bank was tasked with stimulating the economy and reviving inflation. The goal of the bank, like many central banks, was to maintain price stability, reflecting balanced levels of spending throughout the economy. The problem, however, was how the bank would achieve this goal. Like other central banks around the world, the bank operates by influencing the cost and availability of money in the economy. In the 1990s, the main way to inject money into the economy was by adjusting interest rates. Central banks play a crucial role because they are the banks of other banks. The central bank has the power to set the terms of loans to other banks when they need funds. Similarly, it can set the interest rates paid to other banks on deposits held at the central bank. This is very similar to what private banks do for deposits. Controlling interest rates is an important mechanism through which the central bank manages the flow of funds in the economy and their health. When the central bank changes the terms of interest rates, it has a series of effects on other sectors of the economy through the channels that direct the circulation of funds in the economy. First, by changing the interest rates applied to or paid by the central bank to other banks, the central bank incentivizes other banks to change the interest rates applied to borrowers or depositors. Banks compete with each other to offer the best interest rates and attract customers. When the central bank changes interest rates, the cost of deposits or loans at banks increases or decreases. This means that banks must pass on the change in cost to their customers. Ultimately, the central bank's interest rates are reflected in all interest rates in the economy, from credit cards to bank deposits, from business loans to savings accounts. Interest rates influence the choice to spend now or save now and spend later. Interest rates influence the opportunity to spend now or save now and spend later. If you have $100 now, if you leave it there, next year it will be $110. But what if you are told that if you don't spend it today, next year it will be $200? Then your judgment will change. Although this is an extreme example, it explains how interest rates work in the economy. If interest rates are high, people are more likely to save and less likely to spend and invest. If interest rates are higher, more people will save, fewer people will spend, fewer businesses will invest, and the economy will slow down. If interest rates are low, they discourage saving, encourage consumption, and stimulate the economy. Second, interest rates are related to the value of assets present in the economy. These can be financial assets, such as stocks, or physical assets, such as housing. When interest rates fall, the prices of these goods tend to rise. This means that people who own assets are better off, and when they become richer, they tend to spend part of their increased wealth. For example, when the value of a house increases, people take out a bit more in loans instead of spending. In other words, when interest rates fall, aggregate wealth increases, leading to greater spending on consumption. The concept of the income effect, as understood by economists, works differently depending on whether one is a saver or a borrower. For borrowers, lower interest rates mean lower monthly repayments on mortgages and other loans. Naturally, the increase in disposable income will lead to greater consumption, stimulating economic growth. Conversely, for savers, lower interest rates mean lower returns on savings. In addition to saving in bank accounts, savers also manage their debts, such as mortgages. The net impact on personal finances therefore depends on how these two elements are balanced. In the economy as a whole, the impact of these effects on income depends on the relative proportions of savers and borrowers and how each group adjusts their spending in response to changes in income. If savers and borrowers respond to changes in income in the same way, their opposing responses may cancel each other out, and overall spending may not change significantly. However, economic trends suggest that borrowers are more likely to increase spending in response to an increase in income compared to savers who reduce spending in response to a decrease in income. This suggests that, in general, low interest rates tend to stimulate spending throughout the economy. This phenomenon is fundamental to understanding how central banks use interest rate adjustments as a tool to manage economic activity. By lowering interest rates, the goal is to encourage borrowing and spending, especially when the economy needs help. This strategy is particularly effective in stimulating sectors such as consumer goods and real estate. Increased spending can have a ripple effect, leading to greater economic growth and stability. Fourth, there is a channel through the banking system itself. Because banks can lend to citizens at lower prices, low interest rates tend to increase the amount of lending in the economy. The demand for credit is increasing, as people want to obtain loans to finance their spending and investments. At the same time, banks are more willing to lend. One of the reasons is that the costs of issuing and maintaining loans are decreasing, and people, becoming richer, have more valuable assets to offer as collateral. The increase in credit stimulates the money supply, which in turn stimulates economic activity with consumption and investment. All of this leads to an increase in demand and therefore an increase in inflation. Finally, when central banks lower interest rates, exchange rates also tend to fall. For example, when interest rates fall in the UK, the value of the pound also falls. If interest rates fall in the UK but not in the US, the relative yield will be better if funds are transferred from the pound to the dollar. In this way, funds flow across borders, and more people want to buy dollars and sell pounds. This change in demand causes the price of exchanging pounds for dollars to change and makes it more expensive to buy dollars with pounds. This increases the price of imports and therefore inflation. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have. We will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.